So, welcome back, everybody. So, today on Learn Financial Literacy, we'll be taking a look at the topic of loans and interest rates. So, what are loans, first of all? So, loan is something you borrow, most likely a sum of money that is expected to be paid back after you've borrowed it. So, this is issued by either the government, bank, etc., and they give you a sum of money that you borrow, and they expect you to pay it back, obviously. You're not just going to get free money. But this is also very much like loaning your friend a video game. So, for example, you bought a new video game and then you loaned your friend it. You gave it to them to let them play. Once they're done using it, then they give it back to you. So, in essence, you're doing them a favor. So, like getting a loan is asking for a favor from the government or a bank. So, it gives you a tool and allows you to do stuff using this money, such as investing, buying something that you otherwise wouldn't be able to do. However, at the same time, they're not just going to be passing favors out for free. So that's why these loans, they usually have varying interest rates. So what is an interest rate? Interest rate is a sum of money that you have to pay back regularly at a particular rate for the use of money lent. So once you borrow this sum of money, then when you pay it back, let's say you borrow $100, but over the course of some time, let's say a year, you pay it back. But now they ask for kind of like a little incentive. They want to know why should they lend you any money. So you agree on the rate, for example, $10. They have to pay back an extra in addition to the $100 that you borrowed from them. So these rates, they always depend. They depend on various factors. For example, you have to think from the perspective of the person lending the money. So if you're lending the money and you're lending it to various different people, all these people want this money to be used. However, each person, they have different circumstances. Like, for example, one person, they have a secure job, the other may not. So you rather likely give this money to the person with a more stable income. The rate also depends on what type of loan it is, how long it is, what are the risks involved, and this we'll talk about in terms of risks and investments later on in a different video. So today, something we'll be focusing on is something that is very important in the near future about student loans, and as well as the interest rates that you have to pay back. So, post-secondary education in Canada can be very expensive, and some may even top $80,000 in expenses for living there and tuition fees. So, with post-secondary education costing so much, it is very difficult for many to pay right off the bat this large sum of money because you don't have $80,000 lying around. So, it could be beneficial for many to apply for grants and loans given by the government or private corporations to pay off this debt and alleviate this pressure that arrives immediately upon entering post-secondary education. So first off, let's clear up what the difference between a grant and a loan is. So loan I've already defined, but grants are something that the government gives to students, certain students that require financial need, and they give these without needing to repay them. So there is a Canadian Student Loan Program or Canadian Student Grant Program that's available, and these benefits are federal benefits. So it's given by the federal government of the Canada, and you can check these out. Post the links down below so you can check these out. Furthermore, there's also provincial grants. So for students in Ontario, there is the OSAP. So there's a link also down below to see the amount of grants that the Ontario student OSAP can give you. So with these out of the way, these grants out of the way, these are the best option to pay for student tuition. However, what's left, there are loans that you have to take out. So for loans, there are different forms of loans, and the best form of loans are subsidized loans. So these are loans for undergraduate students with financial need. And basically what these loans are, they do not accrue interest rates. So you don't have to pay extra money while you're in school. And This is for a definite period of time. So you want to use these forms of loans above all others because you don't have to pay any additional money. So for example, after you've used up all the subsidized loans and all the grants, and you still require some money for the tuition, then you have to resort to private student loans. So these are from corporations or from banks, etc. And usually these have the highest interest rates. So what you want to do is try to minimize the amount of private student loans and maximize the other two, mostly grants, of course. In the end, when you're paying back these loans, because eventually you have to pay it back. Remember, it's a borrowing of money. A loan is borrowed money. You want to pay off the loans with the highest interest rates because interest rates they gather up over time. So the longer you have borrow a sum of money, the more interest you have to pay. So first off, you want to pay off these private student loans, then any of the student loan programs, and then finally clear off all your debt. So hopefully you find this helpful. You can check out the links below. They are very interesting, very helpful, and very practical links. Hopefully you guys can better understand interests, loans, and have a better grasp of paying for your tuition. And see you in the next video.